Good morning and good afternoon to everyone. My name's Ian Coles and I'm the global head of the mining finance team at Meyer. We're delighted to have this opportunity to present on mining sector prospects today, which is obviously a very current theme. We're even more delighted to have John Meyer as our principal speaker. John's a partner at SP Angel. I'm sure many of you read their daily bulletin, which is full of insightful nuggets. I will moderate along with my partner, Robert Hamill. Rob's a partner in the corporate team at Meyer and is very, very active in M&A, IPOs, and other work in connection with the mining industry. This webinar is part of a series we're hosting during July called Mining Insights, the Meyer perspective. Further details are available from our website. And on that note, we'll get started. So, Rob, over to you for the first question.
Thanks, Ian, and thanks, John, for joining us. So first off, so mining stocks seem to be back in favour with iron ore, copper, and other base metals all doing well. So what's happening, and can this last?
Well, yes, I think it can last. It's clearly a unique situation in our lifetimes, and we are faced with clearly a very sharp pullback in demand, which has occurred in the first few months. Well, towards the end of the first quarter and through much of the second quarter. But it has some very interesting ramifications. We know that most economies around the world are looking to restart and kickstart their economies through construction and through new infrastructure and various stimulus programs. We've added up around $16 trillion of financial pledges. The Bank of England has come up with nearly a £1 trillion worth of stimulus pledges. Much of that is more financial than going into infrastructure. But many other countries, particularly the Chinese, are pressing ahead with getting their economies back on track as fast as possible. So within the context of all that, we are looking at a very interesting supply-demand picture for many commodities. And what we're seeing now is that commodities, in fact, have recovered quite a lot faster than we had anticipated, and significantly faster than many other people had anticipated. Conventional wisdom is that the demand side of things will be weak because clearly we've entered into a recessionary environment in the first half, and the jury is still out as to where exactly that's going to go. I mean, many of us are looking for a V-shaped recovery. There are some people looking for L-shaped, shall we say, economic environments, and commodities are reacting to what is actually happening with metals drawdowns out of warehouses, with metals inventory builds in some cases, although we're very pleased to see it's mainly metals drawdowns that are occurring right now. And much of that is really being driven by China, of course, as the dominant consumer of many metals and many other commodities. And the key thing in the current context is actually the supply disruption being caused by the various lockdowns and now by the actual virus itself impeding operations in different parts of the world, particularly Latin America.
Right. I mean, sort of in addition, I think in the sort of copper markets, I mean, there's been a lot of publicity about the fact there's very few new deposits out there as well. So, I assume that's sort of feeding into the supply side.
I think the pricing of commodities is more related to what's kind of happening today. I think the markets have become very immediately reactive to, well, is metal going in or coming out of warehouses right now? The current situation is there have been pretty sizable drawdowns of copper, but that has left some of the other metals behind. In fact, I think lead is going to be very good because we're seeing a lot of people who had left their cars sitting in the drive for a while have suddenly got back into their cars as their economies open up and they're allowed to drive around the place, and suddenly they discover their batteries are flat and in fact their batteries are dead. So we are seeing this impact. It also causes people to go out and look to buy new cars. It's funny how the one small component can actually drive people's buying habits to some degree. But I think people are saying, "Oh, let's treat ourselves to something new anyway." So there are a lot of moving parts here, but I think yes, there has been a lack of successful exploration in recent years, and in fact, the junior market was fairly well starved of cash for quite a while. The junior explorers that we see now are the great survivors. They're the ones with the better quality projects, the projects that have real tangible value, and the ones that are now in a position where they can say, well, we've got feasibility studies. In some cases, those studies have been optimized once or twice. Better ideas have been put into the mix. Capital costs have been refined. All that sort of thing. And I mean, if we look at gold, of course, the price has gone up a lot. So the economics have been transformed. And actually, again, with the coronavirus, the cost profile has also changed because local currencies have fallen, energy costs have come down a long way, and actually what it means is margins are so much better that the bank financing that was quite elusive for a while is looking much easier to get, and we're beginning to see this. I mean, we saw a major London bank looking or in fact pledging project finance for a lithium operation in Brazil the other day, which is quite an unusual thing. So yes, I mean, from a mining company perspective, the environment is a whole lot better than it was, and investors are beginning to appreciate this.
Right. I mean, you mentioned gold, which obviously is I don't know if it's spiked yet, but it's obviously on a very upward trend, and sort of lots of moving parts there. But there's sort of worries about inflation. But sort of broader question is, to what degree is activity generally in the mining market been fueled by a weaker US dollar?
Yeah, the weaker US dollar is a new thing because the dollar's been strengthening for some years in a long-term trend. But there's I think there's a view now that the US is not as strong as it was, and there are quite a number of reasons for the dollar to weaken, probably on a slightly longer term basis as well. Clearly, the Americans are going to have to dig their way out of the coronavirus situation as well. They'll build a certain amount of infrastructure to do that. I mean, Donald Trump was talking about spending $1 trillion on infrastructure before the coronavirus. So now he's just got even more reason to do that. And certainly the US is in need of repairing infrastructure and building new infrastructure. And people like Elon Musk have got some fantastic ideas for doing that in innovative and unusual ways. But I think I wouldn't want investors to just come into the market on the basis of a weaker dollar. But clearly that does help gold, that does help all commodity prices in dollar terms. But in reality, I mean, I think the key drivers are more fundamental than that. But certainly a weaker dollar it helps, and the gold price will move minute by minute with dollar moves.
And because, John, the long-term economic prospects for the economies of the world are currently clouded by the COVID-19 virus, can we accurately predict the long-term future, do you think, of mining stocks?
That's a very interesting question. I mean, it's my life's work to try and predict these things accurately, and as we know, something tends to come along to spoil that accuracy. In the environment we're in, that's clearly the biggest event is the coronavirus and what that's done to global manufacturing in the world. And I think what many economists would forecast, which would be a deep and long-lasting recession, is probably not going to quite happen in that way in this case. I mean, there will be countries that get caught out if they don't stimulate properly, and there will be some form of longer-term cost to all this, because countries that are borrowing huge amounts of money are going to somehow have to repay that or write it off. We may be in a situation where the money that's borrowed is effectively treated as if in the way that war loans were borrowed, and some of those war loans were only paid off by the British government in the last few years. A bit painful for the people who put their money into that sort of debt, and the chances are it means that interest rates are going to remain significantly lower for longer than was previously forecast. Although I have to say, forecasting interest rates is a pretty difficult game, and not something I want to get involved in. But I think for mining investors, the fundamentals are, well, what is the price in dollar terms likely to do in the next 6 months and few years, and what are the costs likely to be as well? And we know that the costs have come down because of local currencies and lower fuel prices, and a few other sort of local variables, shall we say. And at the same time, whilst commodity prices in many commodity prices have been hit in the first part of the year when the coronavirus really had its impact, those commodity prices are clawing their way back up extremely well. And what's driving those commodity prices is the disruption to in the supply chain and to the mines that supply the market. And every time we see a mine go offline somewhere in the world, it has a positive impact on the underlying commodity. Now, and I think that's what the market failed to appreciate back in March, April, and May, when prices were quite depressed. I think the market was saying, "Oh, demand is going to get really hit, but the supply will carry on as if nothing much happened." And yes, the mining companies are brilliant at dealing with health issues, as they were with Ebola, and as they are now with the coronavirus, and they're fantastic at organising testing and the PPE kit and all of that. They're quite well used to it. But this is a virus that if it goes around your factory or your facilities or your community, I'm afraid it does mean that things will grind to a halt. People will have to go back to their families to look after people. They simply can't work if they're not well. And it is a virus that spreads. It spreads quite fast through a community. So what it means is it can knock out producing operations for certainly for weeks, if not for a bit longer. The cost of those producing operations doesn't seem as bad as it might do. Certainly, if I look at some of the companies we've been working with, they've been able to maintain by using the downtime for maintenance. They've actually been able to maintain production guidance and targets, although it remains to be seen what happens to the costs through that. And so we're still waiting for we'll be waiting for the financial results to come through. But it seems that shall we say, the outright disasters and collapses are not happening. Companies seem to have been well enough prepared to get through this, and I think we have reason to be more positive than we were.
Right. So I guess this is obviously going to have long-term consequences, but what's the sort of guess for the supply-demand balance for the remainder of 2020, or is that just too difficult given where we are in the sort of COVID world?
Well, these are always difficult numbers to add up anyway. But if we go back a few months, the market was forecasting quite sensible, quite big surpluses to build up in copper and the other metals. And actually now, if anything, the forecasts are for either modest surpluses or potentially even deficit situations. I don't think, I haven't seen deficit for anyone being brave enough to forecast a deficit in copper yet, but it is quite possible that we may end up that way because the virus is still working its way through some copper producing regions, and I'm thinking of Peru and Chile, and Brazil is having a very tough time as well. And you don't have to knock out many of those big copper mines for very long to change the supply-demand picture quite radically. So I think the market's fairly finely balanced, in my view. Yes, demand has been hit and will be lower than it was last year by certainly a few percentage points. But equally, the supply may well be hit as much, by something either as much or something close to that. So I don't think we're going to see big stock builds that might depress the market for years to come. If anything, it looks like it has the potential to be either relatively well balanced or possibly even go the other way.
So, John, given all these circumstances, which mining companies look like good investments right now? Obviously, with the usual legal disclaimer that this is not investment advice, and the price can go down as well as up.
Yeah, prices can go up as well as down. Most people don't say it that way around for some reason. And I will caveat: we are advisors and brokers to the companies that I will talk about. And in some cases, I've even bought some of the shares myself in recent months, because when the share prices came down, they suddenly became very attractive stocks indeed. I think I can start with Bushveld Minerals because it's a good illustration of how we see the global environment. Bushveld Minerals is a primary vanadium producer operating out of South Africa. That means it's very low cost, although quite a lot of primary vanadium production is at the bottom end of the cost curve. But in the environment that we're in, we've seen supply interruption to secondary vanadium production. Anything that was coming out of scrap or anything that was coming out of high vanadium content iron ore has been reduced. So there's less supply. And we can see that steel prices have been rising in China. Iron ore demand has been very good in China. We saw iron ore prices over $100 a ton for quite a while. They're back at $95 a ton, but that's still a pretty good price. The Chinese are buying more vanadium out of Australia, which has less vanadium in its iron ore, and that's good from a supply restriction perspective. But the key here really is that China increased its vanadium content for structural steel, mainly rebar, a couple of years ago. It's been creating better compliance for those new rules over the last year, and we are seeing the construction of more projects, more infrastructure projects, both local and national projects, in order to drive the economic recovery. And so China's been pretty quick off the mark, as they are. They've had more projects in planning than probably any other nation anyway, in terms of the proportion that they spend. And that is driving strong demand for steel locally. And much of that steel is structural steel, mainly rebar, which requires more vanadium content than it used to. So I think this is going to drive a rising price for vanadium, and that will drive margins for Bushveld. And we are seeing the price in China rising faster than anywhere else in the world, because we look at the vanadium price in terms of what it is in China versus Europe and the United States. And traditionally, Bushveld sold more into the US than anywhere else, but in fact, I think that's going to change because the price in China will simply draw metal in that direction. So for me, Bushveld, it will benefit from local cost reduction because of the weaker South African rand, weaker energy costs, and hopefully a rise in price in vanadium. Though we haven't seen we haven't seen a huge rise in the vanadium price in China yet, it is certainly going in the right direction.
Right. So we've touched on gold, which is to some extent unique as a sort of financial asset. But there's been a lot of sort of talking up of other precious metals. Platinum Group, I've seen a lot of webinars recently where from CEOs of silver companies talking those up. How do you see sort of other precious doing in the sort of near to midterm future?
Yeah, I've never been a huge gold bull. One doesn't want to get tarred with that brush, but but gold certainly has a very positive environment behind it. As you mentioned, the dollar is weakening, and the outlook for the dollar is for further weakening. So that helps to drive gold prices. Certainly, the huge amount of money printing going on in the world is another positive for gold, because eventually that has to be inflationary in some way. And gold, if you think of gold as it's an alternative currency, the miners that produce gold can only mine it at a certain rate, and the world appears to absorb that at a faster rate than I think the guys mine it at. And so gold prices seem very well supported. Investors continue to buy gold, and it is seen as a better currency to hold than many others, because you simply don't know if you're holding dollars or pounds or yen. You just don't know how many more yen or pounds or dollars that they're going to print next week. And certainly the money printing machines are going at a faster rate than any of us have ever seen in our lifetimes. And nobody's producing $16 trillion worth of gold, over the next year or two. So actually, it seems that that is a better instrument to hold in many respects. And in an uncertain world where there can be more shocks to the financial system, and we were warned by the governor of the Bank of England that the UK financial markets nearly melted down a few weeks ago. Not that any of us really noticed, but we nearly had another post Lehman Brothers moment there. So and that certainly caused the Bank of England to inject, I think it was another $350 billion into their stimulus program to help to bail the government out, in effect. So yes, it does look as if gold has the potential to go reasonably higher from here. And I would have thought breaking through $2,000 an ounce is not beyond where it can go.
And John, how do investors get exposure to gold? I mean, obviously investing in gold mining companies. Are there other ways that they can do that, or is that the best way?
Well, I would be careful about buying gold bars and things like that. In fact, there's a massive scandal developing in China where there's a huge tonnage. I think it's 85 tons of fake gold bars have been discovered, and probably there'll be more. So one's got to be wary of that. I'm also concerned about ETFs. I mean, there's an enormous amount of money in gold ETFs, but of course, any financial instrument like that, unless it is fully backed by physical gold, can be a bit risky, because if the bank that's written the ETF goes bust, and that is always a possibility in this type of environment, then how are you going to get your money out of that? So for me, the equity markets look like the safest place. Equities go up and down, again according to the flows of investment flows. But at least the stocks, the companies are there working away, producing in the background or developing their projects. So for me, equities feel like the safest way to play this, and you get the benefit of much higher margins and hopefully dividend flow, if not current dividend flow or future dividend flow. And I see that as much better than holding many other sectors. So I think many investors were shocked when Shell Oil decided to cut their dividend. and I'm sure these investors will be looking to come into some mining stocks, which are much more look much more solid in the environment that we're in.
And just as a quick follow-up as well, Ian was talking about other precious metals, and people talk about the gold to silver ratio, and that even with the improvement in gold prices seems to be narrowing a bit. What's the implications of that?
Well, I've never liked this sort of ratio idea because it's not a fundamental thing, if you see what I mean. For me, silver is a byproduct metal. It's more a function of how much copper is produced in Latin America than anything else. But it does seem to adhere to this ratio idea, and many people trade gold and silver on the back of that sort of thing. And we used to look at the gold oil ratio as well. So one can create ratios for all sorts of things, and once in a while they will diverge. But yeah, I personally would prefer to be investing in gold than silver, but I do understand that when the gold price gets above a certain level, people do like to switch into silver, and they see that as a good alternative store of value, which is fine. And certainly silver mines will benefit from the rise in price in the way that many gold mines will as well.
Right. I mean, we've spoken quite a lot about gold. Are there any particular gold companies, whether sort of major, mid-tier, or junior, you particularly like the look of?
Well, we focus on the juniors. I mean, for the majors, it's pretty simple. You look at Newcrest or Barrick or Newmont or something like that. But we focus on the juniors, and I'm certainly I'm very keen on Scott Gold, Condor Gold, and Coles Minerals at the moment. And I see those companies as popular with investors. I see them as stocks that have good leverage and could do really well in this gold price environment, because I think certainly for Coles, the higher margin that it can earn on its Tulu Kapi project should be transformational, and they're busy putting the project finance together on that. And if they can get over the line with the project financing and all the other bits and pieces that need to come together, then that would be just a transformational event for that stock. Condor, again, they've been moving towards getting to the point where they can finance and build the La India project in Nicaragua. Again, it's a tough country, but we are in an environment where countries will bend over backwards to allow these companies to get on and actually start building their projects, because these are very large infrastructure projects in the context of where they are. So for Kefi in Ethiopia, that project is transformational to the regional economy there, and it will be a very big deal for them. Again, with Condor in Nicaragua, it will be a big thing for them, and it's the sort of thing they need to help get the economy restarted after the coronavirus. If we look at Scott Gold in Scotland, clearly a very difficult country from a UK perspective sometimes, but a very nice, easy project, and I think something where investors will do quite nicely. And I think a project which will, well, it won't benefit from a depreciation of the Scottish pound, but I think it will benefit from Scottish nationalism and the additional value that many Scots will pay for Scottish gold coins.
That's great. Thanks, John. So we're coming towards the end of our allotted slot. So I'd like to thank everybody for joining, particularly to John for his very interesting and perceptive comments as to what's happening in the mining sector and metal markets nowadays. We hope those who are listening found it helpful. Please do get in touch if you have any follow-up queries. If you'd like similar information on any of our other webcasts, in particular in this series in relation to the mining sector, please let us know by contacting your usual Meyer Brown contacts, or you can email our events team at lon-events@meyerbrown.com. So thanks again for listening, and we look forward to joining our future webinars. Thanks again.